Well, as we mentioned before the break, Sadiq Adatia is cautious on Canadian stocks in the S&P TSX composite index, but bullish on emerging markets like India. And recently, in fact, he's been to India, and quite recently, he's in fact been to China. Talk to us a bit about what you saw in China.
Well, before I do that, I just want to highlight, I may be negative on the TSX,
okay,
but I am very positive on the Canadian soccer team.
Okay.
So I'm hoping for them to win coming through.
Me too, me too.
Yeah, no, if you look at emerging markets, you really have to go country by country. And you do have to start with some of the two biggest countries out there, right? Both India and China, 1.4 billion population. So if you think out in the future, your portfolio cannot include these companies, right? Because they're going to be such a big part of a geographic landscape and dominating, demand and consumer preferences along the way. So, in India, what I would say is, if you go back 5 years ago, pre-COVID, when I was there, it's a night and day difference between what you're seeing. Infrastructure has been really rebuilt. You're seeing consumers be a lot more stronger in their preferences, more discretionary spending. The middle class is becoming a lot bigger and more wealthier. So they're actually influencing what actually drives the economy in India. So again, you're seeing those big brands show up in India a lot more. And that's similar to what we would have saw in China about 10 years ago. So there is a bit of a lag of where India is compared to where China was at. And you're seeing, obviously, continuity on the political side, though not a majority, which may have a little bit of negativity there. But I think the fact that it's an incumbent that's still won gives you this ability to continue on that momentum that we've seen across the board. And you're seeing that in confidence in corporations as well as on the consumer side. So to me, this is where you want to be investing today and continue to be investing longer term.
What is your view on things like in emerging markets like corporate governance, government regulation, regulation of markets? These are all have all been over the years, I think, legitimately at times concerns of North American investors.
Yeah, and that's what you get when you invest in emerging markets. You're not going to get the North American governance structure that you see. Even think about Japan. Japan didn't really actually move into that proper governance structure till more recently. So I think those are the risks that you have to take on, but that's where the sizable returns are there. And that's why it's important to do your homework and why I went down to India just to kick the tires properly to understand that.
Go ahead.
Yeah,
I was
going to say on China, on the other hand, right, what we see there is, again, we have seen lots of growth in China over the last 20 years, but it has been slowly slowing down over time. Now, what I would say is long term, I still am very bullish about what goes on in China. Again, great population growth. Again, consumers are going to be spending quite a bit over time. And again, it's still a powerhouse that we need to remember, that can actually do a lot of things very quickly. Number one in the solar power world and EV space, and continue to dominate some of the healthcare stuff as well too. However, in the short term, what I am seeing is consumers saving more and not spending as much. You're seeing the property sector still have issues across the board. When I drove by there, I saw many buildings that were completely empty, not a single light on, wow, construction that wasn't developed. So what you're seeing is consumers are just scared, right, to invest because they had money put into the property sector that hasn't done well, and that's causing them to be a little bit more cautious. So until that changes, governments step in to do a lot more than they've already done today. You might still see that cloud over China, and that's why I think India is actually creating a better opportunity as companies slowly pivot a little bit in the short term to areas that they see more opportunity in the short term, and India kind of wins off that side of it. But again, you have to be there to see these things, understand what's really being said. When we get a North American perspective, it really is biased, right? Even on the election side, to understand what they're going to do on the election side, whether it's Trump or Biden as example, you don't get that true story unless you actually speak to the right people there. And to be honest with you, though they are aware of Trump because of what happened last time, I don't think they're really actually, a preference here on their side between Biden and Trump in terms of how they're going to move forward. Sure, I think they may prefer Biden over Trump a little bit, but I think their strategy is not going to change dramatically as a result of that.
Each investor is different, but how does an investor answer the question, how much emerging market exposure should I have in my portfolio? Well,
I mean, we go back to the number one question, which is, should your portfolio be diversified across all regions and sectors and geographies? And the answer is yes, bonds, equities, again, across the board. So you should have your emerging market exposure, but you shouldn't necessarily be trading in and out of it as much because I think it is a long-term play and you need it to pay out. And you get these spikes along the way. If you're out of it, you're going to miss out on those opportunities. So to me, roughly, if you think about your equity exposure, roughly about 5 to 10% of that equity exposure should be in emerging markets, and they should be diversified across different regions. With our belief, a tilt towards China and India.
And we talked about briefly stock market regulation. Do you advise people to own North American traded ETFs or North American traded ADRs or the equivalent? In other words, securities that trade in Toronto or New York?
So I think that's one good way to kind of avoid some of that stuff for sure. But again, I think you still want to own things in the local market as well, right? In China, the A shares or the A shares, those are still important. You want to own from that perspective. But I think you can get exposure through ETFs. We have a phenomenal ETF business, and you get exposure to any of these things through our ETF side. But I think more broadly, to have an edge against in the market on terms of performance, you need to have actually local people on the ground looking at things carefully and buying in the local markets. So that's why I think our advantages are and why we've had some really strong returns across the board.